Now, this morning, President Trump slammed Powell, calling him a fool. He said there's, quote, virtually no inflation and, quote, tariff money pouring into the U.S.
In a closely watched decision, the U.S. Federal Reserve has opted to keep its benchmark interest rate unchanged, holding steady at 4.25% to 4.5%. This move, which aligns with market expectations, comes despite mounting political pressure from former President Donald Trump and amid growing concerns about inflation, unemployment, and the broader impact of ongoing tariffs. Federal Reserve Chairman Jerome Powell offered a measured and cautious explanation for the central bank's decision to hold interest rates steady at the 4.25% to 4.5% range. In his remarks, Powell emphasized the complex and evolving nature of the U.S. economy, highlighting the dual risks of rising unemployment and inflation, both of which he linked, in part, to the ongoing trade tariffs imposed by the Trump administration. According to Powell, the current economic landscape is marked by uncertainty. While inflation remains somewhat contained, the potential for future price increases lingers beneath the surface, especially as tariffs drive up the costs of imported goods. These cost increases could, over time, pass through to consumers, stoking broader inflationary pressures. On the other hand, the strain from these same tariffs on American businesses, particularly exporters and manufacturers, has led to signs of weakness in hiring, wage growth, and corporate investment. If not carefully managed, this could result in higher unemployment and slower overall growth. In light of this, Powell underscored the Fed's commitment to a data-driven wait-and-see approach. Rather than reacting to political pressures or immediate market sentiment, the central bank aims to remain flexible and responsive as more economic data becomes available. Powell indicated that if signs of significant economic deterioration emerge, the Fed stands ready to act, potentially with rate cuts. However, preemptive or politically motivated rate changes could introduce unnecessary volatility or even backfire. Ultimately, Powell's message was clear. The Federal Reserve's mandate, maximizing employment and stabilizing prices, requires thoughtful, independent decision-making. In his view, the best way to navigate a challenging economic climate is with patience, prudence, and a long-term perspective, not reactionary policymaking. President Donald Trump responded to the Federal Reserve's decision not to cut interest rates with characteristic intensity, unleashing a flurry of sharp and personal attacks against Fed Chair Jerome Powell. Trump, who has a long history of berating Powell despite appointing him in 2018, took to his social media platform, Truth Social, calling Powell a fool and a major loser for what he sees as a failure to act decisively in favor of the U.S. economy. In one particularly pointed post, he dubbed him "Too Late Jerome Powell," expressing frustration that Powell hadn't used interest rate cuts to aggressively boost growth. Trump's core argument centers on his belief that there is virtually no inflation, a claim he supported by citing falling energy prices and decreasing grocery costs. From his perspective, the tariffs imposed on imports, particularly those from China, are not harming the economy, but strengthening it, protecting American industries and forcing better trade deals. He argued that a rate cut would serve as jet fuel to the economy, amplifying the positive effects of his trade and tax policies. Instead, he claimed Powell is not in love with me, suggesting that personal animus may be influencing the Fed chair's decisions. Trump has long portrayed himself as an expert on economic matters, often arguing that he understands interest rates and markets better than seasoned economists and central bankers. His criticism went beyond policy. It became personal and political. He accused Powell of undermining the administration's economic momentum and hinted at removing him from the role, only to later walk back those comments amid backlash about the Fed's independence. Adding fuel to his frustration was the fact that other major economies were acting more aggressively. China, for instance, had just slashed its interest rates, a move Trump saw as a direct effort to gain trade advantages. He compared Powell unfavorably to foreign central banks and claimed the Fed's hesitation was putting America at a competitive disadvantage globally. While President Trump painted a rosy picture of his tariff-driven trade policy, the Federal Reserve and many economists offered a much more sobering view. Fed Chairman Jerome Powell made it clear in his press conference that the central bank's decision to hold interest rates steady was not made in a vacuum. It was, in fact, a direct response to growing concerns about the economic ripple effects of the tariffs the Trump administration had imposed. Powell acknowledged that tariffs, originally pitched as a tool to protect American industries, were actually producing the opposite effect. He cited clear risks to both employment and inflation. According to Powell, these tariffs were making it more difficult for businesses to plan, invest, and hire. As uncertainty around trade policy continued to rise, companies were pulling back on spending, and job creation was slowing down. Economist Javier David further emphasized this point, stating that tariffs were not only increasing the cost of goods but also hurting the labor market. They are simultaneously decreasing growth and negatively impacting employment, he said. This meant that while consumers might not yet be seeing dramatic price spikes, the economy was beginning to feel the strain in other, more systemic ways, especially in job security and business confidence. Powell's approach was one of caution and balance. He resisted political pressure to cut rates quickly, stating that while the economy had not yet shown major signs of inflation or rising unemployment, the potential consequences of continued tariffs warranted a wait-and-see posture. The Fed would only act aggressively, he said, if it became clear that the economic damage was spreading. Meanwhile, Trump's insistence that the tariffs were helping the economy and that there's no inflation directly clashed with the Fed's more data-driven caution. The president appeared to interpret China's recent interest rate cut as a validation of his trade strategy. In contrast, Powell saw China's move as a signal of global economic weakness and the rising cost of a tariff war. While the battle between President Trump and Fed Chairman Jerome Powell unfolded in press conferences and social media rants, it was everyday Americans who began feeling the economic weight of their standoff. The Fed's decision to keep interest rates steady, though based on data and long-term stability, meant there would be no immediate financial relief for consumers and industries already grappling with economic uncertainty and higher costs. For the average consumer, unchanged interest rates translate to sustained pressure on existing debt. Credit card interest rates remained high, mortgage rates stayed relatively expensive, and the cost of financing large purchases like homes and cars did not ease. This was particularly painful for working and middle-class families, many of whom had already been hit by rising prices on everyday goods, products that became more expensive due to Trump's tariffs. Sectors like the auto industry were already showing signs of strain. Toyota, for instance, reported a noticeable dip in profits, a direct result of supply chain disruptions and increased costs stemming from the trade war. Tariffs on imported parts and raw materials affected production costs, forcing companies to either absorb the loss or pass it on to the consumers. As a result, car prices crept up and sales in some markets slowed. Beyond the consumer experience, the broader economic outlook began to look increasingly cloudy. Businesses were becoming more reluctant to invest, unsure of what trade relationships would look like in the coming months. Farmers, many of whom relied on international exports, struggled with retaliatory tariffs from countries like China. Small businesses, often seen as the backbone of the U.S. economy, found themselves squeezed between rising costs and declining consumer confidence. The Fed's independence became a focal point in this landscape. By refusing to bow to political pressure and keeping rates steady, Powell emphasized that the central bank's role was not to serve the administration's political interests, but to safeguard long-term economic health. He stressed that if inflation or unemployment took a sudden turn for the worse, the Fed would act swiftly and decisively. But until then, patience and caution were essential. Ironically, Trump's aggressive push for rate cuts may have undermined market confidence rather than boosted it. Investors grew anxious over the possibility of the Fed losing its independence, which could destabilize the financial system. Markets, which had once priced in multiple rate cuts, began pulling back on those bets after the Fed's announcement, especially as new trade deals, like the one just signed with the UK, hinted at a slightly more stable trade environment. President Donald Trump has repeatedly linked America's economic success to his administration's core policies: tax cuts, deregulation, and aggressive trade moves. He championed his Big Beautiful Tax Bill as the biggest in history, a catalyst for job growth, rising wages, and booming business investment. He argued that corporate tax cuts would fuel domestic growth and attract global investment, laying the groundwork for long-term prosperity. Trump also highlighted a new US-UK trade agreement as a major win for his America First agenda, proof that his tough negotiating style worked on the global stage. He claimed such deals would boost American jobs and strengthen international trade relationships. Critics, particularly Democrats, pushed back hard, but Trump dismissed their opposition as Trump derangement syndrome, suggesting it stemmed more from political bias than genuine policy concerns. He framed his economic critics as out of touch with everyday Americans benefiting from his policies. Despite Trump's upbeat message, financial markets remained cautious. The trade deal sparked brief optimism, but uncertainty lingered due to tariffs, supply chain issues, and inflation pressures. Investors were wary of long-term risks, including global economic shifts and the unpredictable effects of Trump's trade strategies. While Trump continued to tout economic success, the path ahead remained clouded by doubt. The clash between President Trump and Fed Chair Jerome Powell revealed a deeper struggle between political urgency and institutional independence. Trump's public attacks, including calling Powell an enemy, challenged the long-standing neutrality of the Federal Reserve, shaking trust in America's economic leadership. Powell, under immense pressure, stayed committed to preserving the Fed's integrity, resisting politically driven rate cuts. The feud exposed the fragility of U.S. economic institutions, eroded investor confidence, and turned monetary policy into a partisan issue. Ultimately, it underscored how vital stable, principled leadership is to economic resilience, especially when volatility and ego dominate the stage. Trump says he's saving the economy. Critics say he's risking it all. Who's right? Let us know what you think in the comment section. Also, don't forget to like and subscribe for more content like this.